Morning all, and thanks for joining me today, albeit virtually, for a discussion around private markets, specifically as an investment opportunity within what we term alternative investments. What we're going to chat about today is really private markets as an asset category from a multi-managed perspective. And what I mean by that is the type of access point that you're going to be looking at when you're looking at the private markets world. You can do it in a more direct kind of single manager or into the asset yourself type basis, or you can look at it from a much more diversified multi-managed perspective. And I'm going to share a little bit of insight as to why you should consider multi-management within the private markets framework. But first off, I'm going to run through a little bit of a introduction for you on private markets as an asset category. So what are they? Why invest in them? Unpack that in a little bit more detail, give you the ins and outs of the underlying asset categories that make up the private markets universe, and thereafter kick off a little bit more detail around the types of access points available to you as an investor and why we favor the multi-management route in accessing the asset category. So let's get into the chase. What are private markets? They really comprise these four subsets of investment opportunities, with the overarching characteristic that they're all of these strategies or sub-strategies are all unlisted, and that they don't have any listed share price or daily share price by which that you can see and touch a value for them. They're valued on a much more infrequent basis, and they don't have that luxury, so to speak, of having a daily share price that quotes the value of them as you would in the listed or traditional investment areas. So first up, private equity, top of the picture there in front of you. Private equity is most akin to listed equity in that in buying a private equity business or buying into private equity, you're buying shares in an unlisted company rather than in the listed counterpart, you'd be buying shares in a listed company. So private equity really comprises an investable universe of companies, be it large, medium-sized or mid-cap in nature, or small and startup in nature, that are just not traded or listed on any public exchange. Private equity is often misconstrued with being a collection of businesses that are sort of startups or businesses that are developed out of garages and haven't really been funded yet and are conceptual and are just ideas. That is a very relevant category within private equity termed venture capital, but it's quite a small component of private equity. And private equity as an investable universe comprises businesses that are just not traded or unlisted, but are very similar in size to many listed companies within the JSE, for example, here in South Africa. Private equity as an asset category, probably the most illiquid within the private markets investment universe, be it by virtue of the fact that if you buy a private business, typically you don't have a share price to buy and sell out of. So the only way that you get out of these investments is that you need to, in essence, sell your shares to somebody else, and that takes time and is typically brokered on a bilateral basis between buyer and seller and can take years. And so typically the holding period here is a lot longer than you would have to endure, say, in the listed space. But with that longer holding period comes the potential of risk. So private equity businesses more often than not are growth businesses that are growing their earnings at rates that are well above inflation. So you as an investor here can access a collection of businesses that are high returning, that to pay you back for your, so to speak, patience with the asset category. And the next asset category within private markets is direct property. So direct property speaks to a collection of property assets that are quite similar in nature to what you would find on the listed exchanges by virtue of underlying subsector. So you can invest in retail assets like shopping malls or office assets that obviously house various corporates, head offices across the country or globally. Or you can invest in industrial warehouse type assets that are key kind of central distribution points for goods and services across the country. So the broad subcategories of property assets that you get access to within direct property or within the private market space are quite similar to what you would find in the listed space. The key distinguishing feature here is that the underlying assets in the direct property portfolios in the unlisted space comprise a collection of assets that you just don't get in the listed space. So if it's the convenience mall down the road that you do your weekly grocery shop at, that mall is, for example, if it's owned by a private property practitioner, it's highly unlikely that you would get that same asset in the portfolio of a listed property practitioner. And so the direct property portfolios that you can access in the private market space just include a much more diverse and much different opportunity set from an underlying property perspective relative to what you get on an exchange. From a risk return perspective, the asset category is more liquid in terms of being able to generate more frequent cash flow for you as an investor. So most of these property assets have well-established tenant bases that pay lease repayments to their landlords, and that's attractive from an investor perspective because those lease payments form a periodic cash flow that you as an investor can earn before your ultimate investment return is monetized from a capital perspective. So there's income generated in these property assets and capital return at a point in time when you sell your property portfolio. So a bit of a mixed bag, or slightly more liquidity conscious than, say, a private equity allocation. Then the next category to mention is private debt, most comparable to your traditional fixed income asset category, much more liquid in terms of its cash flow profile, and that you're in essence funding debt issuances by a range of different borrowers. It could be the large JSE corporate looking to grow its business and expand by virtue of it raising debt from a bank. That debt paper that it raises is private in nature, and so it can get repackaged into a private debt fund by a private debt manager and then be investable for you, the investor. That private debt issuance typically is structured in a way that the borrower has to repay that loan over a defined period. And those issuances can be as short and dated as 12 to 18 months or as long as 5 to 10 years. But typically, because they can be shorter dated, there's a better liquidity profile with private debt allocations relative to your private equity or direct property investments. So you get cash flow pretty much the month after you invest, more often than not when you invest in a private debt fund or a private debt instrument, and you get periodic cash flow pretty much through the life of your investment. So more liquidity conscious than the other two asset categories. And then finally, infrastructure, the last asset category within the private markets investment universe. And that's the one asset category that's probably the least represented on any listed exchange, be it locally or globally, and comprises two subsets of kind of investable assets. One being utility scale or large scale infrastructure like roads, rail, water, energy, all of these kind of key kind of socially required services that are linked to kind of large investable assets that provide you as an investor both with a attractive capital gain in terms of long-term capital gain, but furthermore periodic income generation that's inflation linked and adjusted. And then the second subcomponent within infrastructure is called, or we term social infrastructure, and that speaks to things like affordable housing, retirement accommodation, and schooling, all of which can be actively invested in within this subcategory of private markets, and delivers both an attractive inflation-linked return plus delivers key social or societal outcomes. So those are the three of the four sub-asset categories that comprise the private markets universe. So to reiterate, private market strategies that we've mentioned really, simply put, are all unlisted. So if you're investing in this asset category, don't expect immediate return on investment in terms of cash back. It's a more patient asset category and requires a longer-term investment horizon, and typically requires more patient capital to access. A couple of examples that give you a real good flavor as to what the underlying investable universe looks like within each of the subcategories mentioned is depicted here and visually for you to see. So on the private equity side, for example, you can see a couple of brand names there that are pretty much household names in South Africa in terms of businesses that we see and touch on a daily basis, and gives you a flavor as to sort of the size and sophistication of some of the businesses that you can invest in when you invest in private equity, for example. So be it if you need to change your tires, typically you knock on a Tiger wheel and tire down the road and you get a quote and you think about replacing your tires as and when. So kind of key businesses that you pretty much are fundamental to kind of daily life that are often private equity businesses. And Tiger wheel and tire, for example, has hundreds of branches nationwide, so large scale operating business with a great track record of doing good in the community. So an example there of a business that you see and touch daily, that's a private equity business. Prime Media, another great example. They own many of the radio stations that we listen to, albeit more at home now than in our car on route to work, but nevertheless, a business that owns both radio stations and does a range of outdoor advertising through billboard advertising across most of the main roads in urban centers. So again, a business that you would see and touch on a daily basis that you perhaps didn't even realize was a private equity business. That's both investable, large scale, and can generate an attractive return for you as an investor. And then Consol, another example of a business that pretty much makes every single glass that we drink out of in South Africa. So again, you're seeing and touching this private equity business pretty much daily, perhaps without even knowing. And all of those businesses they're listed are kind of multi-million and or billion rand businesses from a revenue earnings perspective, to give you a sense of size and scale of these assets. On the direct property front, there are a couple of examples. I may have mentioned it a little bit already in passing, but the gym down the road that you train at, or the small convenience center that you go and buy groceries at, these assets are great examples of property assets that, not within any of the listed REITs, for example, the growth pointers of the REIT fund, not held within those constructs, but held by private property practitioners that you can then get access to by investing in private markets. Private debt, two examples there. Loracult is a retirement village that was funded through private debt managers, so building a great piece of social infrastructure, being a retirement home with private debt capital, and so you as an investor get an attractive return that's linked to kind of a debt interest rate, but at the same time deliver a great piece of social infrastructure that benefits the community, and more so you, if you're a part of a pension fund contributing to a portfolio that delivers that, you're in essence building a retirement village that you could retire into one day. Spartan, another small on-lender of finance that can be accessed in the private debt space, whereby Spartan on-lend to smaller SMEs for them to grow and develop their business. So a couple of nice examples as to what private debt practitioners can do in their asset category. And then infrastructure, as I mentioned, large-scale utility-type infrastructure assets like the toll roads. So, for example, the N3TC down from Joburg to Durbs, great piece of infrastructure or road infrastructure that's critical to both economic kind of activity, so the movement of goods and people to and fro from kind of port to city, but furthermore kind of commuter traffic, just the movement of people in and around the country and going on holiday and that. So, a great piece of a utility scale infrastructure that delivers both an investor return, an attractive return for investors based on the fact that the asset collects toll tariffs, and those toll tariffs move at inflation plus, and so the net return outcome for you is an inflation-linked return as an investor, but you, as I say, as an economic participant, get the benefit of the development and the maintenance of a great piece of key utility scale infrastructure in the country. Cookhouse Wind Farm also listed there, a great example of a large-scale clean energy asset. It's probably one of the biggest wind farms built in South Africa. And again, delivers kind of an inflation-linked return outcome for you, because energy that Eskom pays for from Cookhouse is charged to Eskom at an inflation-linked tariff. So you as an investor then get that inflation hedge through your return, but also you get the delivery of a key piece of utility scale energy infrastructure that delivers energy into the grid and obviously keeps the lights on, which we all need. So hopefully those examples have given you a little bit more flavor as to what's investable within the asset category. So why invest in them? And I may have touched on a couple of the features of these assets and or the investable universe already, but to summarize, diversification, probably the key attraction here, given that these assets represent pools of investable assets that are just not available to the mainstream, for example, that those which are investing in traditional assets only in the listed exchanges. You don't have many infrastructure assets, for example, that are investable there, or you don't have many toll roads or certain niche property assets not reflected on the listed exchanges. So, if you include private market assets into your portfolio, what you do is you introduce a different return series or investor return series. And if you introduce a different return series that's less correlated to what you would have in the traditional space, typically you can reduce volatility and improve investment return. And so that principle of diversification is critical in thinking about why investing in this specific asset category. The long-term nature of the asset category also allows for more activist kind of ownership by participants in this asset category, so they can make more meaningful change in the investments that they make, be it from a fund manager perspective, investing in private market assets. You can make positive change in these assets over long periods, and thus creates notable societal benefits. So hence the kind of point around targeting ESG attributes. So you can improve how businesses are run by improving governance standard. You can improve the way that they manage their environmental interactions, so be it from a water saving, recycling perspective, and the like, and what energy they use. So do they use dirty energy or clean energy? You can change that. You can be more an active change agent, and so drive better societal outcomes through investing in this asset category. The inflation protection component I've mentioned a little bit, but in essence, each of the asset components, be it direct property, infrastructure, and the like, all have an inflation hedge inherent in their design, which is of course key from an investment perspective to make sure that your returning investment is linked to inflation over a long period. And then access is key in this asset category. So it's a little bit more nuanced access. So key that you invest in the right opportunities through the right intermediary, and that will assist you to more diversify your portfolio and drive that diversification benefit, adding the right return streams, albeit different return streams to your portfolio. And then finally, enhanced return, as I mentioned, is available here with patience and acknowledgement of the fact that this is not an in and out or a speculative type investment, but much more of a patient kind of long-term allocation to assets that grow, develop over time, and don't kind of bounce around with your kind of typical listed volatility or the volatility of listed equity markets. So that's in a nutshell the why. To expand on that in a little bit more detail, to think about the depth and breadth of the opportunity set within the asset category, and this chart really depicts the number of listed companies that have been available over time since the late 90s in both the US and South Africa, and speaks to the fact that the number is shrinking. So there's a whole lot less companies that are listed for various reasons. But nevertheless, if you look at the end result of this graph, you're looking at between 250 and 300 listed counterparties across the US and SA specifically, which means not a whole lot of investable companies that are traded, not a whole lot to choose from. And furthermore, that typically then can drive some quite negative investor return outcome in the form of, if you have too much capital available in global markets or domestic markets, then you have very few or declining number of investable opportunities, which is not great from an investment 101 perspective. Too much cash chasing too few opportunities equals average returns or below expectation returns. So by contrast, if you look at the number of SMEs in the domestic market, specifically here as depicted by this pyramid, it shows you that the top of the pyramid, specifically the little gray kind of small pyramid at the top, shows you that there are in excess of 8,000 to 10,000 SMEs with turnover in excess of 100 million rand within the South African market. So you compare that to the, say, 250 to 300 listed companies in South Africa, it really speaks to the fact that there's a depth and or breadth of investment opportunity here available in the private markets that can augment and or positively contribute to the returns of your portfolio should you invest wisely and prudently, of course. But nevertheless, speaks to the thesis that way more investment opportunity is present, therefore potential for you to access superior returning investment opportunities through targeted allocation to private markets, which can then complement your traditionally asset-heavy portfolio. So now that we've run through private markets, conceptually, the investable universe, unpacked some of the kind of the asset categories in a bit more detail, and the thesis around why you should invest in the private markets and add it to your traditional asset-heavy portfolio. Now let's think about the access point and talk about some of the potential challenges in investing in unlisteds, specifically, be it through kind of your single manager or kind of try and do it directly yourself. And then think about and present the thesis around why do it in a multi-managed setting and what benefit they can bring you as an investor. So a couple of the considerations here listed worth really incorporating and dwelling on and thinking about. So as we've kind of mentioned, the asset category itself does offer instruments that are unique in terms of their societal benefit and impacts, and also their return streams, which are inflation linked and attractive. However, despite these benefits, you've got to also bear in mind some of the challenges that make them quite tricky to incorporate in portfolio. So I'll go 1, 2, 3, 4. First up, illiquidity. The challenge with private markets is the illiquidity, in that you cannot, as a institutional pension fund or even as a retail investor, enter a private market investment and then expect cash back immediately, or speculate and think that you can enter and exit quickly. It just doesn't afford that sort of trading mentality or that behavior. So you don't have a listed share price. Exits are much more periodic, bilateral, and lumpy in their nature. And so you do need to be patient. It's very difficult or very near impossible to try and price arbitrage or think that you can speculate on private markets investments. It really doesn't work. And it's because there's very limited liquidity and very shallow secondary markets. So bear that in mind. The other challenge too around member mobility, specifically in the institutional setting, be it from a pension fund perspective, is that if you have member-specific challenges within your pension fund, for example, member withdrawals, retrenchments, etc., where it links to a corporate fund, you will struggle to monetize your investment in a private market instrument to facilitate that liquidity on behalf of your members. So it's typically more likely to be funded from the more traditional asset categories, and so you shouldn't overweight your portfolio to illiquid or private market assets where you think that you have potential member mobility issues or member movement issues within a pension fund. It should be tactical and measured in its allocation. And so that's one of the keys and the large and most well-known and well-covered challenge of being invested in the private markets asset category. The second component around access points specifically is that if you do invest in the private markets asset category and you can comfortable with the illiquidity and that you've tactically weighted it appropriately based on your fund size or your kind of cash flow profile within a fund, then more often than not, the inkling is to allocate to a single manager or a single strategy, more often than not private equity. The problem with that is that you obviously create what we term single manager risk and investing in a single team and at a point in time, which you may think sounds okay and variable because you can do that in the traditional asset categories, but is a little bit more nuanced in the private market space, and that these teams typically have to be together and work together for quite an extended period. So they're generally contracted by virtue of the fund design for up to 10 to 15 years. And so you need to make sure that they are stable, coherent, and consistent in nature to be able to deliver your return outcome. And furthermore, the single strategy bias, which typically is created when you allocate this asset category for the first time, more often than not, most pension funds or investors invest in private equity. The lure of high returns relative to the traditional asset categories is one that is almost too good not to resist. But the problem with that is there is also some bias you create by, say, investing in a single private equity manager at a point in time. You create both that single manager risk, is the team going to stick together? Will they continue to do what they promise they'll do? And then furthermore, you create vintage or asset pricing risk in that the funds, and I'll walk through a little example after this slide around how these funds typically work, specifically in the private equity space, and that these funds, they raise capital and draw down your capital over a period of time. And that defined time period creates an issue around how well that fund will do. For example, if you invested in a private equity fund that was investing in assets pre-GFC, that could really be detrimental if you hadn't invested in any other funds post that, because that fund that was investing pre-GFC would be buying assets at quite high prices, and then would be, by virtue of the way that those funds are structured, would have to then sell assets post-GFC at a point in time at potentially much lower asset prices, which means you're creating that asset pricing or vintage risk by investing in a single manager or single strategy at a point in time. So it's the need to, if you're going to invest in private markets, you need to be more dynamic, and you need to think about investing, continually investing and diversifying away that time period or asset pricing risk when allocating to the private markets asset category. The other complexity or challenge is the potential charges, penalties, and challenges around scale and size that you encounter through this asset category. So if you were, for example, to have a liquidity issue within a single fund or single manager allocation within, say, private equity, it's very, very difficult to get out of that pre-maturity. So these funds for example, have typically 10-year lives, and the secondary market, or the market for you to sell your interest in a fund like that, is very shallow. And what it'll actually result in is you probably take quite a big discount to your current market value of your investment to get out, because you're in essence having to forego some value to encourage another investor in to bear the remaining illiquidity risk of that fund for the life of that it has to run. And there's also a couple of other onerous features that if you're doing single fund investing outside of trying to get out, but also the ongoing management of a commitment to a single fund, be it in the private equity space, the need for liquidity by that manager is typically quite periodic and lumpy. And in so doing, that cash flow drawdown or administration that ensues is typically one that you have to bear as an investor. You've got to manage that administration component to make sure that you have cash ready to honor commitments that you've made to this fund over a period of time. The challenge that comes in here, if you don't honor your commitments to a fund of this nature, the penalties and or kind of consequences from a value destruction perspective of your interest in that fund can be quite onerous. So, for example, if you miss a capital call from an investor, from a manager in the private equity space, they can take your fund interest and sell it to other fund investors at a discount to your current market value. Because the reason being is that, of course, if you don't honor a capital call in a closed-ended fund like a private equity fund, you are prejudicing the return of other investors who are reliant on that capital to invest in transactions and assets that can then create a return for the collection or the pool. So you compromise the pool or the benefit of many by not adhering to kind of what you're required to do. But nevertheless, charges, penalties, complexity there that you need to also bear in mind. And then the cost and the expense, the nature of the asset category is one that's also a bit of a deterrent. Typically, private markets are not cheap. Fees are quite high. And there are quite a number of strategies that also accrue quite heavy performance fees, albeit above certain target returns. So you need to also bear in mind that allocating to single managers of this asset category is not necessarily going to be the cheapest thing you've ever done, and is something that you need to be cognizant of, that the mandates are typically expensive, and it's the nature of the game. I mentioned a little bit of the challenges around private equity funds specifically, and this J-curve graphic really depicts that challenge as faced by many pension fund investors historically and on an ongoing basis, in that this is typically the return profile of what you could term a conventional closed-ended private equity fund. And the return graph here depicted is called the J-curve, and you can see that little shaded area below the zero on the far left-hand side is what you can see the kind of the bottom of the J. And why do we call it the J-curve, and why do you get a J-curve? It really speaks to some of the points I mentioned earlier around fund design. These funds are close-ended, so they raise capital at a point in time. Then they, at that point, let's say left-hand side of the zero that you see on the horizontal axis, they haven't yet raised, they raised, and they get to that 0 point. And then what they do is they start calling the capital from you as investors. When they call capital, they typically then invest the capital, but it may take a certain period of time. It could be a year, could be months. It depends on how good they are as managers and how good they are at sourcing investable opportunities that they can match with your capital. So there's a typical delay in them drawing capital and thus investing at your capital. And what happens, and why that the return graph goes negative in the shape of a J, is that they are drawing fees on your capital commitment. So you commit 100 Rand to a 200 Rand fund, they will draw fees on your capital commitment, the full value, despite only investing a component or a small portion of that capital over the coming years. So you're paying fees on a very high committed capital base, whilst your invested capital base is quite small. So they've only drawn a portion of your capital down, but you're still paying fees on how much capital you said you were going to give to them. And that means that if you pay high fees on a very high committed capital base, and your invested capital base is small, if you do the calcs on your NAV, you're effectively earning quite a negative return at the outset of these sorts of funds. As time goes by and as the assets mature and develop, then your return should improve. However, it's not really that exciting from a pension fund perspective to earn negative returns for a defined period. It doesn't make you very competitive, given, especially if traditional asset categories are performing well. And if you pick badly and you pick a single manager that doesn't do so well, this J-curve can look a whole lot more negative, in that you could take a whole lot longer to get from below zero back up to zero into a positive returning territory at later in the fund life. And by that time, you would have paid the manager quite a lot of fees and have seen very limited net return benefits. And so this is a little bit of another one of the challenges of backing a single fund, single strategy options within the private markets investment universe that needs to be borne in mind when investing here. So that's given you a flavor as to challenges inherent in the asset category more broadly, and then specifically private equity, where there's been a lot of active allocation of funds or institutional investors historically. I think private markets from a return dispersion perspective should also be considered and thought about as being more than just private equity as an allocation universe, and that each of the underlying asset categories has different risk return components. So, and I would have touched on this a little bit earlier, but to formalize it here into a nice little picture, you can see on the far left, unlisted credit, for example, has more moderate excess return potential, but is much more income friendly. So it generates a more modest return, but a more liquid cash in hand type return in a more rapid fashion, relative to, say, private equity on the far right hand side of the graph. You can see is much more capital growth orientated. It's very illiquid, but it has a much higher return potential expectation. And then you can see infrastructure and direct property are kind of a blend of the two. They have some income features. They have more moderate return expectations, so to speak, than private equity, but generate a return premium above, say, conventional unlisted credit. And so there is merit in investing in private markets in a way that blends and considers the benefits of these various asset categories as a collective. And that kind of leads us nicely on into the construct of a multi-managed solution within private markets as being one way to invest in the asset category to mitigate some of the challenges that we would have mentioned already. So if you invest in a multi-managed solution and blend different investment strategies, be it private debt, infrastructure, property, private equity, you can blend different imperatives, be it income generation and or capital growth. So if you then consider how you can blend these categories, the liquidity component is the first kind of problem to solve. How do you solve that? You allocate more to private debt strategies and or mature infrastructure strategies that are generating cash more on an orderly basis. That gives you some answer to your liquidity solution. It doesn't solve it, so don't by any means think that you, by investing in certain sub-asset categories, you are totally liquid, but you can partially mitigate it through investing in different asset categories that give you more of a liquid or a cash return profile. And if you combine that in such a way and you create scale in a program, such as we've tried to do, then you can actually help assist your funds, your clients and your investors with liquidity solutions earlier than your typical single fund manager that has a 10-year, 12-year time horizon. You can, in essence, use some of that cash that you're getting on an ordinary basis from private debt, infrastructure, direct property to enter and exit member funds that need some form of liquidity solution. You can also, through blending strategies and creating size and scale in a program in the multi-managed fashion, reduce the charges and penalties associated with the asset category through brokering better fee arrangements and thus driving down the impact of any J-curve through lower fees and focusing on deployment. You can also reduce the expensive nature and or the single manager bias through blending multiple strategies and multiple managers at different points in time. You create a much smoother, more consistent return profile than, say, backing a single manager within, say, private equity. And so you kind of create a more lowly correlated, lower volatility return outcome, which is quite complementary to your traditional asset categories. And the return dispersion component and the J-curve implications can also be mitigated or reduced through allocating across private market asset categories. Private debt instruments typically are much more money in the ground, faster, able to deploy faster, and so you get a return faster. And so that can mitigate, say, the negative J-curve impact of a longer dated private equity allocation that's going to be negative to some extent, and then only positive and be more capital growth oriented later on in your return lifespan. So a couple of the benefits, the pros and cons here are listed in terms of how you can mitigate some of the challenges with the asset category through blending strategies and targeting it on a more multi-managed fund-of-fund type basis, which we've we've strived to do for our clients, and to date, thankfully, I can say we've succeeded in doing a great job. So that's the kind of architecture that I think we prefer, and we think is quite value accretive to the asset category and or clients investing in the asset category. To summarize a couple of the kind of features and or kind of controls that that we've implemented and I think are key for a successful program in the private market space, specifically on the multi-manager front. Liquidity considerations through proper portfolio design around strategy mix and or manager mix, and thinking around vintage and or diversification thereof. Looking for the best managers and getting the best deals, both from a fee and or access to the best assets perspective. The research and the diligence and the tax and legal issues needs to be well covered off and really managed on a very explicit basis between intermediaries, be it on a fund-to-fund or a single manager basis. The drawdown and administration process, again, critical, key to be managed to ensure no penalties and charges are incurred for clients or for your investment. So another kind of key feature of the kind of an aspect of a successful program. Diversification by manager, strategy, and vintage. I think I've kind of drummed on about that in terms of the benefits thereof within the asset category and what it does for you as an investor or from an investor return perspective. And then reporting and accountability, critical and key, and a key feature we also provide for our clients is around making sure reporting is clear, consistent, and accurate around returns, attribution thereof, and the evaluation of underlying assets to ensure that they are fair value and are done in a way that's reflective of best practice to ensure that ultimately clients and or members are getting kind of a daily unit price that's effective of their value within the asset category. So on that note, I'd like to thank you for listening. Hope it was useful and insightful, and yeah, look forward to engaging with you once again, hopefully in person. Thanks for your time.